Do you trust Wall Street with the quality of your life in retirement? If you're listening to this podcast, you probably don't. Today, we're going to share with you an alternative strategy to your 401k.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And today we're going to be talking to you guys about whether you can replace your 401k with the infinite banking concept. Anthony, what do you think?
You know what I'm thinking is, how have we not addressed this before?
We've definitely danced around it.
Yeah, and I think we've... okay, never mind about the dance. We have discussed it, and I think it's more in theory.
Yeah.
But what we're going to talk about today is just more of a little more details.
Mm-hmm.
And we're also going to discuss some math.
Yeah.
Here, we're going to discuss some numbers to support your options. And I will say that at the end of the podcast, I got a couple things that are going to be well worth the wait. And Cameron, I didn't even tell you them.
Oh, wow. I can't wait.
Well, the reason being, because on one of them, I think you're going to be so surprised, a little hair might pop out of place.
No.
And that happened once before, and you made us re-record the podcast. So I'm trying to avoid that time. But there's some interesting things that we discovered in going through this, and I'm going to share them at the end.
Man, I'm excited. All right. So today what we're going to be doing is we're going to start with some pros and cons of infinite banking versus a 401k. And so we're going to go back and forth and kind of share the pros and the cons. And then after that, we're going to get into the comparison. How does that sound?
That sounds good.
Awesome.
I will say, Cam, the way we broke this up, I was presenting like the pros and cons in the 401k.
Yeah.
That was not easy for me.
Ooh, why do you say that?
I think part is, to be honest, I'm biased.
Oh yeah.
But so I'm trying to come at this with a open mind and really back to my CPA days.
Yeah.
Because your CPA is probably going to recommend that you max out your 401k.
Yeah.
So I tried to dig into that old person there. But you know what I also did for some research? I wanted to get some other people's opinion.
Okay.
I was like, is there a community of like-minded people that I could maybe ask some input from this?
And did you find one?
I did. And I found one in our community, in our Facebook group. So this is just a little CTA. If you want to learn more about infinite banking and kind of passive income strategies, you can join our private Facebook group, and you do not need to be a client. But what I found was interesting when I posed that question, a lot of them were kind of similar to the compliments I give you, Cameron, where they're a little backhanded, where it sounds like it's a compliment, but then wham, of course there's not. So it was the same thing there. So where else I went?
Where
would people go? Chat GPT.
Oh, okay. Yeah.
And and what was interesting when I asked them the pros and cons of a 401k, at the end, and I hadn't seen this before, but it asked me for a prompt. Do I want to compare a 401k to infinite banking? And it's probably because it knows that I'm asking a lot of infinite banking questions. Yeah. So later towards the end, I will share what Chat GPT did when they discussed the pros and cons of infinite banking versus a 401k.
Interesting. Okay.
Now, let's define what we're referring to when we say 401k. Okay. And we're painting this with a very broad brush. So it's a 401k, could be a SEP or some sort of IRA. And I'm also including Roth IRAs for the most, but we're mainly going to be focusing on more of the traditional, meaning that you get a tax deduction going in and you pay taxes coming out. And the reason why we're going to focus on that is because that's what most people have.
Yeah.
Right. But they have more of that traditional 401k. And also, as much as I like, I mean, if I'm going to do one, I'd rather do the Roth. The difficulty is it's hard to get a lot of money in there. right? Because there's limits on an IRA and there's limits on the 401k, and even the employer match. If you have a Roth, the employer match portion is still more of traditional. So
Is this the introduction, or are you already going into the cons? You're beating this thing up already.
Oh, no.
Oh,
I'm
okay,
just
yeah,
giving the definition.
Yeah. Oh, okay.
I'm just giving the
Yeah,
definition, right? So
yeah.
when we say 401k, we're kind of lumping all of these up together.
Gotcha. Yeah.
Okay. So my number one pro or advantage or that I found of using these 401ks is that it's easy.
All right. What do you mean by that?
Really, now the way the government's done it, you don't literally have to do anything. They're automatically opting you in to the 401k. But even before that, like, you don't have to read a book.
Yeah.
You don't need to go to meetings. You don't need to meet with anybody. You just need to check a couple boxes. So it's very easy, very easy to start a 401k.
Nice. I'm talking about IBC and just anybody new or brand new. When we mention infinite banking concept, what we're referring to is Nelson Nash's strategy that he introduced everyone to becoming your own banker when he published it back in 2000. I would say there's kind of two parts to the strategy. One would be the product. Hey, we want to use a whole life product from a mutual insurance company that is specifically designed for cash value accumulation. And then the second part of that is the process of banking, is of taking loans against that cash value and paying it back. And so that's what I'm referring to when I talk about infinite banking. Anthony, your first pro was it's easy. I would say for infinite banking that it is mid, as my kids would say, right? It's not super easy, but it's a step or two above, right? Just throwing money at it, is because you do need to do some research. One, you want to find, you need to learn about the strategy. There are some pitfalls you want to avoid. Make sure you got a good coach in those things. And there's going to be some effort that you want to put forth in kind of making this thing successful. So I wouldn't say that it's easy, but I definitely say that it's mid.
It's mid. Okay. That's good. Good. Yeah. The second pro that I have about a 401k is that it's passive.
All right. What do you mean by passive?
I mean, everybody loves passive. I mean, I have it on my shirt. Like we want that passive income, meaning it takes very little effort. So when I'm talking about easy, I mean, to be able to get in to play the game. But as far as managing your account, it's pretty passive. I mean, there's a wide range of funds. There's even some age-dated funds, so you can almost kind of set it and forget it. And so it doesn't take a lot of effort to maintain it going forward.
Was that a Ron Popeil reference? Set it and forget it?
No.
Yes, it was. Okay, wow. All right. Do you know who Ron Popeil is?
No.
Oh, wow. Okay.
Or maybe I do.
Yeah, he's the guy, the infomercial guy that he would do the rotisserie chicken, and I think he had like hairspray. But anyways. All right. Moving on, Anthony. Keep us on track.
I like how you trigger his hair. I mean, like you mentioned his hair, but anyways.
He was famous for set it, forget it, and then also, but wait, there's more.
Okay.
So that was the guy.
Okay.
Sorry. All right. Second one you said is that it's passive. You know what? I'm not going to call infinite banking passive. That you do need to be active, right? On the first part, I said the education piece to it is you need to go out there and you need to learn about it. But also, right, the piece where we're going to be leveraging the cash value is, man, there's some education that's going to be involved. Is you got to go learn about these investments and what it takes to be successful. And so I would say that it's not passive. Yeah.
Now, this next reason why the pros of 401k, and I think that this is the reason most people participate in 401k, is that we have that immediate tax benefit. Like you are getting a benefit or appears to be a benefit immediately.
Yeah. Right. And this is, I think a lot of that is why CPAs are promoting it. Right. Cool. All right. So on the infinite banking side, as far as taxation, what I said is you're going to be funding these policies with after-tax dollars, and there is a tax benefit. The benefit is you have the ability to deduct the interest that you're paying to the insurance company. So, great point.
Okay. Now, another advantage of having a 401k is that there may be an employer match. Well, what you gonna do with that with the IBC guy over there?
Well, I had that listed as a pro. is that there is no government nor employee oversight as to what I'm doing. Everything is on the individual level. And so I can do what I want when I want, Anthony.
Okay. Well, this next one. Okay. Another advantage of a 401k is that you can turn off contributions very quickly.
You thought you had me on that one, but you don't. With infinite banking, I too can turn off contributions with a little caveat.
Yeah. See, yeah, right? There's a little caveat.
Little time frame, right? Anytime after you're 7, you can shut premiums off with really no taxable event, no bad consequences, anything like that. So there is a little bit of a time frame, but outside of that, after you're 7, infinite banking, we too can turn contributions off.
Well, I would also say, even if it happens beforehand, and that's one thing we always recommend our clients keep some portion of cash value in their policy. So if they're unable to fund the premium, we can use that to fund the premium. But for that first 7 years, that premium must be paid, whether it's out of pocket or from a policy loan. I will say, I think the 401k has more flexibility without the repercussion if you were to turn that off.
I agree.
Another pro of a 401k is that the money in your account is asset protected.
We also have asset protection in IBC. It's state regulated, so each state is different. We've got varying levels of credit protection. If you guys have questions on what your state is, feel free to reach out to us. Happy to help you guys. Reach out, schedule a phone call with myself or Anthony. And if you've got some cash value, have some questions, happy to answer those for you. But I think there's about 25 to 30 states now that have 100% credit protection on cash value.
Okay, Cameron. Now, another great advantage or pro of 401k is that there's loan options.
Great.
Okay. How about that?
No, wow, you got me. Guys, loan provisions on whole life insurance is one of the things that very few people know about, but everybody needs to understand. And so what I always tell clients is, in this education phase of infinite banking, is we need to know and we need to understand the loan provisions that come along with the policy. The great thing about whole life insurance is that it's a contract. You can go in there and you can read the loan provisions before you even put the policy in place. Some of the highlights that I've listed here is, when you take a loan, you have a flexible loan repayment schedule. The insurance company is not dictating any sort of repayment schedule that you have to do. Simply once a year, you're going to get a notice that says, hey, here's where you're at. And that is it. There's no expectation of payment. Obviously, if we're going to do this and we're going to be responsible with it, is when we take a loan, we do need to set up a loan repayment, but that's what we're here to help you guys with. The second thing that I would make note on loans is that the loans are private. The loans are not reported to any of the crediting agencies that are out there. So if I have a policy loan, nobody else really knows about it unless I tell them. So the privacy is great. The other piece that I would highlight is that it's non-recourse debt. That means I've got a loan against my cash value. If I never pay that back, what they're going to do is they're not going to come after me personally for any of my assets. Is they're just going to take the policy, and they're actually already have the cash value. So they'll close out the policy and they'll keep the money that had a lien against it. The other one is that I've got immediate cash value, immediate access to my policy loans. I have no sort of vesting schedule that comes along with that.
Kim, I like how you use the term non-recourse. I think our real estate investors will understand how valuable that is. But this next one, I got you on.
Are you ready to take control of your wealth and make your money work for you, not the banks? The infinite banking concept can help you build generational wealth, protect your assets, and create financial freedom.
If you're curious if this concept works for you, let's talk. Let's get on a free discovery call where we can talk how you can use infinite banking to supercharge your investments.
Don't wait. Your financial future starts now. Okay. All right, let's go.
Now, and I think this is another reason why people are doing the 401ks. And one of the pros of 401k, everybody else is doing it. Right? All your buddies at work, your boss, your uncle, your mom and dad, like everybody else that you're talking to is in the same boat as you.
Wow. You did have to go back, right, to a while back, the way that you were thinking, because I too wrote down one of my pros is that no one else is doing it.
You know what? I knew you were going to come up with that. Yeah.
And that's why I like it, right? One of the things we say around here is if you're doing what the average person is doing, is you better expect average results. When we first got into infinite banking, there was nobody else that was doing it. We're the lone wolves, right? We're the guys that were out there just figuring this out on our own. And now there's a whole bunch of people that are out there doing it. And again, to kind of bring back our community, if you guys feel like you're a lone wolf out there practicing infinite banking, man, come join a community of like-minded people. We'd love to have you join us.
Okay. Well done, Cam.
Thanks.
Now let's talk about.
Well, wait a second. You're done.
Oh, yeah.
Oh,
That's all the pros.
Those are the only pros
That's
you
it,
got?
man.
Oh,
Are
wow.
there any more?
Wow. Yes, I've got a few more.
Okay.
One of the pros that I also listed here was infinite banking has a successful track record.
Ooh. What do you mean by that?
What I mean by that is at the basis of what we're doing, it's really twofold. One is we're using the insurance company to help mitigate any sort of losses or volatility in what we're doing with our money. We're putting it into a policy that the insurance company is managing, and we're going to get a very even kind of growth rate over time. And you can go back and you can look at the track record of the performance of these policies over the last 175, almost 200 years. And that is a huge advantage in my opinion, to taking a look at the volatility of the market and just having that uncertainty moving forward.
Well said.
Yeah.
You have more?
I do got more. The other point that I would make here is that there are no contribution limits. That's a big one. So a lot of our clients are either W-2, they got a great job, they're wanting to get into real estate, or they're investors and they've got kind of large amounts of capital that just show up throughout the course of a year. One of the best things about infinite banking is there's no one dictating how much money we can or cannot put into a policy. Mm-hmm. And so for me, that's one of the advantages that I see that infinite banking has over 401ks is I can put as much into a policy as I'd like or as little as I would like. Last point I'd make here as far as pros go is we often overlook this. We almost did it here, but I wasn't going to let you do it, Anthony. On the infinite banking side, we've got a death benefit.
I was wondering if you were going to say that. Okay.
So again, right, we're using insurance policy, and what we're doing is we are minimizing that death benefit or that insurance piece on the design phase of it. But again, it's going to be there, right? And so we do have a death benefit that there's to really kind of cover us in case something happens to us along the way. That death benefit or windfall is there to support our family and our kids and our beneficiaries along the way if, God forbid, something happens.
Well done, Cam.
Great. I think that's everything now.
Okay.
Anthony, I'm going to turn it over to you. What are some of the cons of a 401k? What are the downsides here?
Okay, so there's quite a bit. One of the many cons of a 401k is you are limited on your investment options. Most people have a 401k through an employer or even an IRA, and most of the time they're subject to or really limited to stocks and mutual funds. There is that opportunity to do a self-directed IRA for you that opens up some more options for you. But the problem is you can't use any of that personally. The options are still limited. But the bottom line is with a 401k, the government puts limits on what you can invest in. Great.
Well said. One of the cons that when I always talk about infinite banking, the one that I always point out is I would say there's a slow start to infinite banking. And what I mean by that is, again, we're using insurance, and that insurance piece has a cost to it. And really, the policy has a cost in the insurance the first 2-3 years-ish. And so if you guys are out there looking to get started, before you get started, you want to go through and you want to make sure you understand what that slow start is for you and the policy that's being proposed to you. If you guys have questions and would like us to go through that in detail with you, feel free to reach out. Happy to go through it with you.
You know what, on that, let me just hit that home if you don't mind, Cameron, because you're right. That is the biggest obstacle people have is that slow start. But what I find interesting, if somebody puts in $1 in their 401k, let's say under the 20% tax bracket. So they put in $1, they want to take it out. They got to pay the 20% plus 10% penalty. So they're going to get 70 cents that first year. Okay. Cameron, when somebody does a kind of, I know it can be different, but if somebody's putting in $1 to an ongoing policy, And then how much can they take out at the end of the year?
It's about 70 cents.
Okay, so it's about the same. Now, in year 2, I put in $1, but I need that, so I got to take it back out again. So I only have 70 cents. What do I have on a typical policy?
Probably 80, 85 cents.
Yeah, let's just even give it the benefit of the doubt and say it's the same. Okay, so the first 2 years are equal. But how about in year 3 or year 4? I put in $1 in my 401k. Each year I can only get 70 cents back. What about in the IRA? The IBC.
In the IBC, starting in year 3, maybe year 4, is you're actually going to have more money available to you than what you put in there. Meaning if you put $1 in, you've got $1 and a few cents that you'll be able to pull back out. And the best part of that is once it starts in year 3, is that happens every single year thereafter. So as long as you've got that policy, you put in $1, you're going to have more than it's available to you in cash value.
So that slow start, I know it's the biggest obstacle at first glance, but I believe if you dive a little deeper and look into it, it really is not.
I agree 100% with you. I'm glad you brought it up again, because I'll go through that with clients, and I'll go through it because I want to make them aware of it. Very few times does anybody really have some sort of objection to it when they see how it works. You're going to give up a little bit of access on the front end, but man, you're going to gain so much more on the back end. It's not funny. So
it's not funny.
You're not funny.
Speaking of not funny, Cameron, the next con that we have listed in 401k is that the government limits how much you can put in each year.
That's not fun. I don't like that.
No.
On the IBC, one of the cons that I came up with is there is no employer match. So this is going to be something that you're going to be doing as an individual, independent of any sort of employer matches.
Another downside of 401k is you decide to take that money out before you're age 59 and a half, 10% penalty right off the top.
Yeah. My con is similar to that. As I was sitting there thinking about some of the cons that come up is I always get this question, Anthony, I don't know about you. Clients always ask if they can roll over an old 401k, an old IRA into a policy. And one of the cons is you can't roll that over, is that is going to be a taxable event. And so oftentimes when somebody has a lump sum, it's going to be in one of the accounts that Anthony's highlighting here today. And to get that money into a policy is we do need to liquidate it, potentially pay a tax, and then we'll fund the policy with it afterwards. So that would be a downside.
Well, I tell people they can roll it over. They just got to pay the taxes.
That's true. That's true. Yep.
But anyways, another downside of the 401k is subject to market volatility. And what I find very interesting, it's like, it's never the appropriate time to take the money out, right?
Great point.
Right. When the market's down, don't take it out because it's going to rise again.
Yeah.
And then when it rises again, we don't take it out because it's rising. I mean, you just always end up being in there, but you have, and I know I've shared the podcast a couple of times where when I was on vacation and the stock market went down almost 1,000 points. And if I was really subject to that volatility, that would have really hindered my experience, or that would create stress.
Another con that I have for infinite banking is that when we do borrow against the cash value, is we are paying interest back to the insurance company. Again, this is a con I'm searching here because honestly, I don't see that as a negative. The reason I say that is because too many people out there do not assign a value to their own money. And so when we're borrowing against our cash value, we're required to assign a value to those dollars. And it's a great conversation starter when you're talking to somebody and saying, well, why do I need to pay an interest rate? Well, it's because if you're not paying a market rate against your savings, is you're losing ground against everybody else. And so one of the things that I appreciate about the idea of borrowing and paying an interest rate is that I have to assign a value to my own dollars. So it was kind of a negative, kind of not.
Yeah.
You got any more?
Of course I have one more, Cameron. I even have some more that aren't even on the sheet because I know for a fact that you did look at my nuggets before we did the podcast. Another downside of a 401k is that a lot of times people are doing it because of the employer match, but that employer match is going to have a vesting schedule. Typically, that's over 5 years, meaning if you they put in $1, typically you might get access to 20% of that each year. So if you're there 5 years, then you get all of that dollar. But if you're going to stay below that, or you leave, your choice or theirs, you may not get all of that employer match.
Okay, well said. One of the downsides to infinite banking, and this is said jokingly, is that your kids cannot wait for you to die.
You were searching.
Yeah, I was searching.
Yeah.
I was searching, guys. If you go down this route of infinite banking, you're going to end up with more death benefit than you had intended or imagined. And so that is going to be a downside, is there's going to be that death benefit that's lingering out there. And I wouldn't tell too many people about it.
No.
Yeah.
You know, what I tell my kids is that death benefit increases each year. Okay, so the longer I'm alive, the more death benefit there is going to be. Another downside of having a 401k is you may actually be in a higher tax bracket when you retire than when you're working. And we're going to do the math. I don't even know if we said we were doing the math, but of course we're doing the math. But we're going to compare some numbers of the options. And of course, we're going to hit on the tax, and you're going to be surprised of what we had found.
And I'm all out of cons. I was searching, as you could tell by my last point there. I couldn't find too many downsides to doing infinite banking. I felt like you had quite a few more to 401ks.
Yeah.
Yeah.
Well, there are.
Yeah.
And I will say, you know, in summary, I was surprised with Chat GPT was going to do was going to compare 401k to IBC. I'm just going to go over them quickly.
Yeah.
The first one was the tax treatment. Now, of course, infinite banking was the advantage to that. Liquidity and access to funds, infinite banking wins. Growth and investment potential, 401k wins.
I would agree.
Well, I tell you, if I hadn't heard or done the math that we're about to do, and we're going to kind of wrap this up in the end. So I think that's a common misconception.
And maybe I'm going to clean up the words, is I would agree if that is a 401k versus a whole life policy. I would give the nod to 401k. If it's 401k versus IBC, that's a different story.
Yeah. Now, the fourth column was risk and market volatility. Obviously, infinite banking won for that. Employer contributions and benefits. There's the advantage went to the 401k. Control and flexibility. By far, infinite banking, we have more control. Tax-free retirement income, hands down, infinite banking. Fees and costs.
Ooh.
They had said a 401k has lower fees initially, but infinite banking provides lifelong benefits. So I kind of think the way that they did it might be a little bit more accurate when you're just looking at the fees. They gave it to 401k, but I would like to have a rebuttal on that.
Yeah.
The next column was wealth transfer and legacy. IBC won that. Protection from creditors and lawsuits actually gave it a tie, because most states have asset protection for cash value, but not all of them don't. So depending on what state you are, that might be tie or it might not. But I was surprised overall at the score. It gave IBC 6 and the 401k 4.
Nice. Good to see. I've kind of messed around with ChatGPT and IBC, and to be honest, I feel like ChatGPT didn't give IBC enough credit for what it's able to do. So
well, the problem is, Cameron, the deal is I've been helping Chat GPT learn. So you're welcome.
That was nice of you. Nice.
But and here's what we're going to do, because we do like to we talk more theoretical pros and cons, but we're gonna throw some numbers. And I know most people are probably driving in their car. We're not going to go too deep into them. We are going to create a companion video where we take some time and go through those numbers. But really, Cameron, what would you say the main purpose of a 401k is? What's the end use?
Retirement income.
Okay, I would agree. It's that cash flow in retirement, right? So if that's the main reason why we're doing a 401k, that needs to be the main barometer, right? That's what we need to judge. And so what we did is a little math is on a policy. How much do you need to earn in the 401k each year to provide the same amount of cash flow? Okay. So here's some of the steps that we had used, and along with the assumptions, we just did 20,000 a year. Okay. Now what we did is 20,000 in the policy, and we did this from 40 until age 70. What we also did, and we did the assumption they were in the 25% tax bracket. What I want to point out to that, to be honest, if you're putting 20 grand a year, you're probably not in the 25% tax bracket. You're probably higher, to be honest. So we are giving them a little more of the benefit of the doubt. But one thing I also, I realized when I was doing this, if you're a business owner, you might be in the 25 or maybe lower, because again, there's a lot of tax deductions business owners can have and that employees can't. Not to rub it in, or I'm going to, but I'm moving literally 150 grand off of my tax return that if I was an employee, I would have to pay taxes on that. And that would have also put me in a larger tax bracket. So really, let's say a third of that would have had to go to the IRS. So that's giving me 50 grand more in cash that I can use. So I need to put it somewhere, so I'm going to put it in the policy. But the bottom line is, if we were to put 20 grand a year into a policy and then cash flow when we're 71, we'd have $94,000 a year. Okay. Now, so the question is, all right, well, the first question is, if we put it in a 401k, what's the withdrawal rate? I'm not talking earnings rate, but if we have a lump sum in there, what percentage can we take out, and with the reasonable assumption we're not going to run out of money? Now, the industry has tried to solve that, and you may have heard of the 4% rule, that you could only take out 4% a year. But then with all this volatility, there's been some people saying 2 or 3. I ended up using 3.5%. Okay. Now, in order to take out, so we need to take out 94,000 a year. And if we want a 3.5%, that means a balance we need to have in our 401k, $2.7 million.
That's it.
Yeah. However, I had to count the taxes. Okay. Because in order to pay the taxes, you can't take out 94. You need 124 to be net with 94. So what that means, in order for those taxes, you don't need to have 2.7 in there. You need to have 3.5 in there. Cameron, how many people do you know that have 3.5 million in their 401k?
I cannot think of one that has anywhere near 3.5.
And I will say, the people that have 3.5 million in their 401k they're not relying on their 401k.
Yeah.
Right. They're just using it more as a tax strategy because they have other forms of income. But we also had to take into account fees. 401ks have a lot of fees and a lot of hidden fees. Because even when I was a CFO, we instituted the 401k plan, and it was gonna be like 10 grand a year. Well, I think it was 10 grand the first year, and then there was a smaller amount each year. We're like, man, we're a small company. We don't have 10 grand.
Yeah.
You know what they said? Don't worry about it. we're gonna pass it along to all the employees.
Mhm.
Those guys paid all of those fees, and I tell you, I looked at the statement, it wasn't clear. It's hidden in there. And then to do some research, I went to unbiased.com, and they gave a range of 0.2 to 5%.
0.2.
I can't. Yeah, 0.2. What I have to assume is they're talking 401k fees, not fees maybe inside of a mutual fund or trading fees. Like there's going to be fees in there. But what we did is I used 2.5%, so somewhere in the half there. So the bottom line is, if you were, and again, we're not putting 20 grand in the 401k. I think we're putting about 26. Right? Because we can put more in the 401k because we get that tax deduction.
Mm-hmm.
Okay. So we're putting, so you need to have in your 401, what you need to earn every single year in your 401k to provide the same amount of tax-free cash or same amount of cash flow, 10.5%.
Oh, wow.
10.5% every single year.
Wow, for 30 years?
For 30 years. Think that's possible?
Piece of cake. No.
What I thought was, so I think what is interesting here, I tell you, to be honest, when I did this, Cameron, I did not compare IBC to the 401k.
Mm-hmm.
I compared a high cash value whole life policy to a 401k. Because you had mentioned, with all of your advantages, it's not just having that money not tied to the market. It's that you can use that money to create that passive income. You can borrow against it to buy an investment, have that investment repay the policy. So once that's repaid, you have both. You have that asset, and your policy continued to grow during the same time. And here's what I think is very interesting, Cameron. What would you say the number one reason people use a 401k for retirement? Like, what do you think their biggest benefit is?
Tax deduction.
Yeah. Tax deduction, right?
Mm-hmm.
I'm saving money in taxes because my CPA said, well, hey, if I put 20 grand in my IRA, I'm going to lower my taxes. And I'd rather put it in my account than pay it to the IRS. Totally get it. I used to tell people the same thing. But here's what's interesting. When we went back and counted the taxes that we had paid, because we had to pay tax on the 20 grand, we ended up paying $200,000 in taxes. Okay. But once you started drawing money in retirement, that money's tax-free. Now, the amount of taxes that you have to pay, because remember, you have to pay 30 grand more, draw that out of your 401k, that 30 grand's going right to the IRS. So you're paying $600,000, which this tax benefit that you believe you're getting, you're paying 3 times as much in taxes. And again, we're pulling out 125 grand a year, and we're told we're going to be in a lower tax bracket. 100% of that 125 is taxable. That's not taking into account Social Security. Hopefully they're going to change that where it's not taxable. But if you have interest, or maybe you're working a job, hopefully you're doing something with your time, or you have some other business or other assets that's only going to add on to your taxable income. And also, that's how your premium, the higher your taxable income is, you pay a surcharge for Medicare, which, I mean, we can go super deep, but the point is, the bottom line is, that myth that you're going to be in a lower tax bracket when you retire just ain't so.
Wow. So there's a lot of good information in that. One of the things I wrote down, Anthony, was, I want to confirm I'm hearing you right on this one, is that we're comparing IBC versus a 401k, and the number I usually will share with clients is that a policy is going to grow around 4% annually. And what I heard you just say there, as you got to the bottom of that, is that to equal that, in income is that policy or a 401k would have to grow at 10.5% every single year just to equal what's happened in the policy. That's crazy.
And part of the is because you can have because we don't have that volatility in your policy, we can confidently take out more. So we have a higher withdrawal rate, which means to be ending with the same number, we can have a smaller balance. So even if your policy is growing by 5, your 401k needs to grow double that just to equal it.
That's crazy. So I feel pretty confident that infinite banking is the route, obviously, for myself and for most people. One of the arguments that I'll often hear, Anthony, is, well, I'll do a 401k, but maybe I'll just do up to the match. What are your thoughts on that, especially after going through the math here?
I would say it changed going through the math, because I tell you what, I would always tell people, and honestly, I probably still will, when they're first, new to this, we don't want to, this is a mind shift.
Yeah.
Right. So there is a benefit from that employer match, but hopefully looking at, now that you know the truth about the numbers, maybe even foregoing that company match and adding that into your additional premiums will even more than offset the employer match.
Ooh, that is crazy talk. That is wild. That is wild. Guys, Anthony alluded to doing a video, right? Going through these numbers. Not only are we going to go through the numbers that he just shared with you, but we'll also go through and we're going to put in kind of an example on ways to accelerate the growth of the policy. And again, right, what he's comparing is just the policy. The example that we're going to be sharing with you is how to incorporate infinite banking as a strategy and where you'll end up over a 30-year period. So make sure that you guys listen to this episode and then also join us on that YouTube video that we'll be putting out here shortly.
Go make a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.